gain side, and majority or 80% of the stocks or more of the stocks do not move much. So this is what we saw in performance, and which was in sectors, which was in regions. We did for Dow 30 stocks. You look at Tracy stocks in the Dow, you will still get the same structure. You see it in sectors in America, you will see the same structure. You see in AT&T in 1 day, 5 day, month, year to date, monthly, yearly, 6 monthly, you say the similar structure. You may not see that yearly is more return. 3 monthly here is the highest return, and 1 day is the lowest return. They are not in a similar order, but among them, among the returns on various holding periods, there is an order. So this is a rule called the Pareto rule, which I am explaining you. In a very simplified terms, I am showing you the Pareto curve of 20% of the market doing 80% of the activity, and 20% of the stocks really causing bigger change. 20% of the reason, the 20% of the trading volume, 80% of the trading volume is in 20% of the stock. You see, anywhere you go, there are only few stocks trade more. There is a lot of market which doesn't trade that more. Why is it? It is because, not because we love Sapphire or we love something else. It's because there is an order. And then we can call it say 5 as an order, but there are times there are other stocks which trade more. Obviously, there is always some part of the market which has more interest. It is never an equal interest. This inequality or this proportion has an order which is drawn as a curve and which is seen everywhere in time. This is S&P 500 of 1 day analysis. All the Chinsute Action, you see the same curve. There is some Citrix system is an extreme loss making structure, Southwestern Energy is an extreme gain making structure, and rest of them follow that curve. And 80% of the market is really not making a big change. Only 20%, 10 stocks at the bottom are making big change, and 10 stocks at the top are making big change. Are you with me? Is my voice clear? Okay, so we move ahead. So this is 5-day structure. 5-day structure on S&P 500, and we see that if I change the holding period, then the stocks which are changing also change. Something which is best on a 5-day period is not necessarily the same which is best on a 1-day period, because the holding period is different. Holding period is what performance is about. Performance is not about SIP5 margin source, SIP5 margin Jones. It's not like that. It's about SIP5 is an outperforming cycle for a day. SIP5 is an outperforming cycle for a week. SIP5 is an underperforming cycle for a month. So it depends on your holding period, and this idea has not been discussed anywhere in the world today. So we are saying it is the holding period that changes the performance. Every time it's changing. Performance is pulsing like a heartbeat, or it's a larger performance or smaller performance, but it is all spectrum of performances. This is S&P 500 on a month to date. We have different stocks, and a lot of the market doesn't make a change. A small part of the market does the most activity. The rest of the market is sleeping. So if you have to make consistent wealth, you have to be in the market, in the part of the market that is activity. There is activity. Coca-Cola is the best loss, so you should have sold before it became the best, the extreme loss, and you should have bought Carnival before it became the extreme gainer. And that's the whole idea of pinpointing which stock is going to outperform or which stock is going to be the best. Now this we need a 3-month structure, and you see the same curve. You see the same curve. There is a curve which is coming, and it is smooth, and it's going down straight, and then it suddenly flattens at the bottom. And this curve is seen on all time frames, 6-month time frame, 3-month time frame, and the stocks keep changing. The performance structure keeps changing, and the holding period keeps changing, but the structure remains the same. There is a best performer, there is a worst performer, and there are a section of the market that doesn't change. So what is this pattern? This is a curve. This curve is an exponential curve. There are small big gains and there are small big losses, and there are big large, very large gains and very large losses, and there's a lot of sideways action. It is basically a cycle. The cycle is because if there is an order on across time frame, 1 day has an order, 5 day has an order, 10 day has an order, month has an order, every time frame has an order, then how does the order of various time frame come together? There has to be a larger order, and that order is because the performance is cyclical, because the best performer will not remain the best, because after it has become the best, it will start to underperform, and it may go down in underperformance, and it may also become the worst, which is already the worst loss making structure, will not remain the worst structure. It may start to outperform, and this we call as the performance cyclicality. The best is going to underperform and the worst is going to outperform based on your holding period. If you have a 3 month of holding period, you need to consistently study which are the best 3 month performers, which are the worst 3 month performers, and that means that you have to invest out of the best and you have to invest in the worst, because what has become best is not going to remain there. It is going to underperform, and this is performance cyclicality. So if you say, show me the cycle, I have drawn Komi here. I have drawn Komi on various time frames for performance, 1 day, 5 day, month to day, and you can see there is a cyclical. There is on various time frames, there is a cycle. There is a cycle structure. If I look at various time frame structures, this is another way of showing cycle. I'm just looking at BRB on returns on different time frames. OZ, Chinzile, month to date, 1 month, 30 days, prelude, and I see that there is an order. It goes up and it goes down. There is a kind of oscillator. It is not random. So if I have to nurture the cycle more, if I have to develop the cycle more, what am I talking about? I am saying that if I draw for my holding period H, which can be 5 minutes, 60 minutes, day, week, month, quarter, year, anything. If I know my holding period, and if I rank, and if I'm investing in the red stock, which is the worst stock, then I will see that the worst will start to increase in performance among the group of assets, because ultimately I have a choice. I have a choice what to buy in BetXT. Should I buy Sunpay? Should I buy SIF5? Should I buy Trans Electrica, Transgas? What should I buy? So I am saying that buy the one which is the worst on your holding period. If you have a 3 month holding period, and say for example, what is the worst? I will go to the rankings now, but say for example, Dafura is the worst. So you should buy Dafura on your 3 month holding period, because Dafura in your holding period will outperform the all other stocks in the BetXT. So it will go from lower ranking to higher ranking, higher, and it becomes the best. When it becomes the best, that is time to reduce Dafura or not bring Dafura. And that, or if Dafura had futures, then you can sell Dafura futures. So the same thing you can do on SIF5, and the same thing you can do on any other stock. Tomorrow I'm a two-day trader. The day after tomorrow I'm a 1 week trader. If either you are a short-term trader, or you are an intermediate term trader, or you are an investor, you can trade futures for short-term trading, or you can trade for a week or more, or you can invest. You cannot be moving from one asset class to another, or one horizon. Your risk profile is very clear. Or you may be a guy or a person or a lady who has got two kind of portfolios. One is for investment, one is for trading. Okay, this is my investment portfolio where I buy stocks for 3 months, 6 months. This is my short-term trading portfolio where I trade. So when you are trading that portfolio, you have to look at smaller time period, like holding period ranking. And if you have to look for your larger portfolio, you have to look for your 6 month or 3 month ranking. So this is how the cycle is formed. The cycle is formed by ranking of assets. The number one asset is the best asset. The number 100 asset or 50 asset. Today we have 54 assets in alpha, local alpha that we do. Alpha ROM. Alpha ROM has 54 assets, and in that 54 assets, number one is the best, number 54 is the worst. So if I have to buy, if my holding period is 3 months, I am buying the number 54 asset and I am selling the number one asset. And if that number one asset is SIP 5, I can also sell SIP 5 futures. So this is the structure of performance that I'm talking about, and this structure of performance of changing of rankings can be drawn as a cycle. I can draw it as a cycle. Now this is a cycle of SIP 5 December. SIP 5 December cycle says that when the cycle this is a 25 group stock. This is an older version of the SIP 5. We recently, about a week back, changed to 54 assets because we realized that we need to have a larger group of assets. So this was updated, as you can say, around mid-October, third week of October, it was saying SIP 5 December should underperform, and SIP 5 December is a sell, is a reduce, and I don't want to hold SIP 5 December in my portfolio. And this is because SIP 5 December in October was the best. When it is the best, that is the time you should not hold it. When it is the worst, that is the time you should hold it. So hold or buy, sell or reduce. Of course, we are slowly moving to the strategy side, but I'm trying to explain the concept how performance cyclicality works. Now this was SIP 5 December. Now we have another one here, which is SIP 2. Now this also is a late October, third week October. And in the third week October, this also was turning down. So SIP 2 was also coming from near one or two rankings. One or two rankings basically meant that it was one of the best set in the 25 bit XT components, and this was a bad time to be holding SIP 2. And somewhere around late July was a good time to keep holding SIP 2 because it was outperforming. So even if the market was flat, the SIP 2 would have delivered some returns. If the market was up, SIP 2 would have delivered more returns than the market. If the market was down, then SIP 2 would have lost less or would not have made a loss. So this is what I'm talking about, relative performance, which also can be used in the futures market, because if something is going to underperform, it may also be likely to fall. It may not only stagnate, but it may also fall. And this underperformance or outperformance or performance that we are talking about actual return on the prices. So actual return on the prices, if they say the returns are going to fall, that means it is going to go down. If they say the returns are going to increase, that means the markets are going to increase. Because how can you say the returns of SIP 2 going to increase in 16th July or late July? So that means there could be some positive outlook compared to the rest of the market. So this is how we design, and this we call as Reiki. Reiki is the Japanese for performance cycle, and this cycle is built around returns. If the cycle is the best, that is ranking of 0 to 5, that is the time